Now, cost of capital. So I can say this. It is the required rate of return. It is the required rate of return by providers of long-term funds. It's the required rate of return by providers of long-term funds. The next point. The cost of capital to a firm, is a combined cost made up of component costs. Is a combined cost made up of component costs, i.e., a combination of cost of equity, into brackets KE, comma, cost of debt, cost of preference shares, into brackets KP, and cost of debt, into brackets KD. So when you talk about the cost of capital, is a combination of KE, KD, and KP. So let's have a small subtopic on component costs. And under that, number one, we start with cost of equity. Cost of equity, KE. So cost of equity, that is KE. Then we say it is the required rate of return. By ordinary shareholders. It is the required rate of return by ordinary shareholders. Full stop, then you say. Two methods are available. For calculating KE. Two methods are available for calculating KE. Penye usikie utaniambia. Two methods are available for calculating KE, i.e. Number A, we have Gordon's dividend growth model. And number B, we have capital asset pricing model, CAPM. So we have the Gordon's dividend growth model and we have the capital asset pricing model. Tuanze na Gordon's. So Gordon's model. Now, you remember the Gordon's model we used under valuation of ordinary shares. We had different models there. Among them, we had the model. So we are borrowing from that concept. And remember, all the assumptions associated with it will still hold. The firm is always profitable and pays dividends annually. Payout ratio is known in advance and with certainty. Retention ratio is known in advance and with certainty. All those, KE is always greater than G. Hizo assumptions tulimake zote zitahold as far as this is concerned. Sasa, cost of capital, cost of equity is known in advance and with certainty. Dividend growth rate is known in advance and with certainty. Zile assumptions tulikuwa nazo. So let us recall. If we can recall, pale kwa valuation, PO was equals to, if you can remember, DO into 1 plus what? 1 plus G, right? Then we divide by KE minus G. Or we can have our D1 divide by KE minus G. So D1 over KE minus G. So good. Now from that one, we are required to make KE the subject. So if you make KE the subject, because sasa hapa, sasa tunatafuta KE. And this is what I said while introducing time value of money. I remember saying that time value of money is a small topic, but is applicable in more than, its knowledge is needed in other 3 topics: valuation, cost of capital, and capital budgeting. Now, currently, we are talking about valuation. We talked about valuation, sorry. Now we are in cost of capital. After cost of capital, we'll go to capital budgeting. Concept yake inahitajika huko. So if you make KE the subject, I'm sure by making KE the subject shall have KE will be equals to, if you multiply these sides, you shall have DO into 1 plus G. DO into 1 plus G. Then we divide by PO. Then hapa mbele, tutaongeza G plus G. DO into 1 plus G. Divide by PO. Then huku mbele tuongeze plus G. And kindly, G is not adding on the numerator. G is adding on both the numerator and the denominator. So G is adding on both the numerator and the denominator. So it's all this. Ukishamaliza hesabu ndo uongeze G. So hata hapa naweza ikuwe plus G kuja hapa mbele kama itakubali. Yes, so that is kwa hapa. That is better. So DO into 1 plus G over PO plus G. Kama unatumia D1, we'll have your D1. We shall have here our D1. Over PO plus G. Great. Then hapo chini you can say, in case of a discount, in case of a discount, it reduces the share price. In case of a discount, by the discount initially yake ni small d, so I can put somewhere there. In case of a discount, comma, into brackets d, it reduces the share price. Hence, in case of a discount, it reduces the share price. Hence, so KE would be equals to, KE would be equals to, so kama kuna discount inapunguza our PO. So PO minus the discount. Huku pia PO minus the discount. So it reduces the price. So if the shares of the company are selling at 50, but an investor will be given a discount of 5 shillings, then atazinunua at 50 minus 5. It reduces the price. The next you say, equity comprises ordinary share capital, into brackets, this is external equity, close the brackets, and retained earnings. So retained earnings is internal equity. Sometimes inaitwa pia revenue reserves. So retained earnings pia zinaitwa revenue reserves. So equity comprises ordinary share capital and the retained earnings stroke internal equity ama revenue reserves. Full stop, then you say, the cost of each is determined in the same way, except that in case of a flotation stroke issue costs, into brackets F, small f, it only affects the ordinary shares. It only affects the ordinary shares since retained earnings are never issued stroke floated. You cannot incur an issue cost on what you don't issue. We issue ordinary shares, we don't issue the retained earnings. So if we have the issue costs, they only affect what we issue, and what we issue is the ordinary shares. So hence, kama tuko na flotation cost, we shall have 2 KEs we shall have the KE of ordinary shares. Of ordinary shares, which will have the flotation cost. So KE of ordinary shares will be equals to DO over PO. Kama kuna discount una less, kama kuna flotation cost una less. If you're using DO or D1, kama kuna discount or flotation cost, you less them. You less those ones. That is for ordinary shares, and they shall have another KE for the retained earnings. So shall have another KE for the retained earnings. So KE of retained earnings. So KE of retained earnings will remain as it is. No flotation cost. Only the flotation cost only affects the ordinary shares. They don't affect the retained earnings. I believe at that point, we should be in a position to know what DO stands for. The most current dividends, the dividends, historical dividends. D1 is next year, the expected dividends. G is the dividend growth rate. If kama ilikupita in our previous class, you can just be documenting. Of course, DO is the most current dividend or the dividends just paid. It's about historical, the dividends that were paid. Then D1 is next year's dividends, expected dividends. Of course, G is the dividend growth rate. Don't forget the two formulas of calculating the dividend growth rate. The nth root, most current over the most past, minus 1. Na ile ingine, where G equals to return on equity times the retention ratio. Of course, PO is the market share price. The price of the ordinary shares. D tumesema ni discount on issue of shares, and F is the flotation cost. I think that's fine. If you're okay up to that point, we can have number B. Number B, CAPEM. So capital asset pricing model. So you can see we are just borrowing from what we covered in the previous topic. So we're just rewriting it to calculate now the cost. Now our interest shifts from valuation to the cost of capital. So capital asset pricing model, it considers risk. It considers risk in calculating cost of capital, in calculating KE. Considers risk in calculating KE. Then you say, two types of risk will always affect a firm. Two types of risk will always affect a firm, i.e., number one, unsystematic risk. And number two, systematic risk. So you have unsystematic risk and we have systematic risk. Then you say, unsystematic risk affects a specific firm in the industry and systematic risk ile ya kwanza affects a specific firm in the industry depending on its level of activities, depending on its type of activities, depending on its type of activities. And systematic risk affects each firm in the industry depending on their type of business or the nature of their business. So the unsystematic risk affects each firm in the industry depending on a specific firm in the industry depending on the nature of their business. E.g. low sales kidogo, low sales due to poor weather conditions. Low sales due to poor weather conditions. Full stop. It can be eliminated. It can be eliminated through diversification. It can be eliminated through diversification. Hence, should not be considered. Hence, should not be considered when calculating KE. Hence, should not be considered when calculating KE. Next point, systematic on the other hand, systematic risk on the other hand, systematic risk on the other hand, affects all firms in the industry. Systematic risk on the other hand affects all firms in the industry, e.g. inflation. So inflation ikihit imehit. It doesn't matter whether you are in the business of selling tomatoes or selling whichever the need. Hiyo ikihit imehit. So systematic risk affects all firms in the industry. And it cannot be eliminated, through diversification. And it cannot be eliminated through diversification. Hence included in calculating KE. Hence included in calculating KE. And it is measured using beta factor. And it is measured using beta factor. Into brackets B. Adhayo B inakuanga na E1 yake inakuanga imeextend kidogo. So into brackets B. Next point. According to CAPEM, weka full stop na comma. According to CAPEM, that one, KE equals RF plus risk premium. And this risk premium Risk premium you multiply by the beta factor. RF plus the risk premium multiplied by the beta factor. Of course, risk premium equals RM minus RF. Risk premium is RM minus RF. So in simple terms, it means that I can get my KE by taking RF plus RM minus RF. RM minus RF, then I multiply by the beta. So kama nimepewa risk premium, I can use this formula. Kama nimepewa RM na RF bila risk premium, because I know RM minus RF is the risk premium. So where RF equals risk-free rate of return. Risk-free rate of return. Stroke return from government securities. Return from government securities. Into brackets, treasury bills and treasury bonds. So it's assumed that the government offers the securities that carry no risk. Ukiinvest kwa T-bills za gava, uko sure utapata returns zako. They carry no risk. Then RM equals the expected return on the market. RM equals expected return on the market. Alafu B equals to beta factor. Inaitwa beta factor ama systematic risk. Beta factor stroke systematic risk. So that is about KE. Let's talk about number B. KE was number 1. Number 2. Sorry. Cost of preference shares. Cost of preference shares. That is KP. So cost of preference shares, that is KP. Then we say, yes, it is the required rate of return by preference shareholders. It is the required rate of return by preference shareholders. So let us recall. Pale kwa irredeemable preference shares tulisema kuwa MV was equals to preference dividends and everything we divided by KP. Preference dividends over KP. Now, in this case, we need to make KP the subject. When you make KP the subject, itakuja huku, ikuja hapa. Just cross multiplication. So in our case, KP would be equals to preference dividends divided by the market value. Preference dividends divided by the market value. As simple as that. So we are borrowing from ile ingine, ile concept yetu ya evaluation. Then you can just say where the shares, let's put it this way. In case of a discount, in case of a discount, into brackets D, small d, or flotation stroke issue costs, flotation stroke issue cost, that is F, comma, it reduces the share price. It reduces the share price. Hence, so kama tuko na discount ama flotation cost, ita reduce the share price. So KP would be equals to preference dividends over the market value minus the discount if there is any, minus the flotation cost. So simple as that. So we are borrowing from valuation. Concept of valuation, tunaileta hapa kwa cost of capital. Nice. Then you can have an NB. NB, you say, where the shares are issued at par, stroke nominal value, with no discount, or flotation cost, comma, KP simply becomes the coupon stroke dividend rate. The coupon stroke dividend rate. So unapata examiner amekwambia kuwa the company issued, for instance, the company issued 10% preference shares. 10% preference shares at shillings 100, shillings 1,000 per value. Napata kaswali kama hako. You know that hakuna discount, hakuna flotation cost. When you apply your formula in calculating the KP, we shall have, so hapo wanataka, you are required to calculate KP. So you're being asked to calculate KP. So there's no discount, there's no flotation cost. So our KP would be preference dividends over the market value. When you look at the dividends are always paid on par value. So preference dividends equals to 10%, 10% times 10% times 1,000. That will be the dividends. So 10% times 1,000, sorry for that. That is the dividends, and the market value, they're being issued at par. So the market value is the same as the par value. So if you do this divide by that, and you make it a percentage, if the shares were issued at par and there is no discount of flotation cost, KP simply becomes the coupon rate or the preference dividends or the dividend rate. As you can see from this illustration, the company issued 10% preference shares at shillings 1,000 par value. So the market value of the shares was 1,000. They were issued at 1,000. So meaning ziliuzwa na 1,000 shillings. So the preference dividends, 10% of 1,000 divided by the market value of 1,000. Hata kwa hesabu ya kawaida, if you can see, 1,000 and 1,000 would cancel out. Let me do it this way. 1,000 and 1,000 would cancel out, as you can see. And of course, 1,000 na 1,000 cancel out, tunabakisha 10%. So these and these cancels out. So if the shares were issued at par, hakuna discount, hakuna flotation cost, coupon rate or the dividend rate ndo inakuwa KP. And that is very important. So that is for the preference shares. Then you have number 3, unless there's a question, we talk about long-term debt, cost of long-term debt or cost of debt. Cost of long-term debt, that is KD, or simply put, cost of debt. Then we can say, when calculating KD, comma, debts can be grouped into 2, i.e., we have number A, irredeemable debts, stroke bond, and of course, number B, we have redeemable debt, stroke bonds. So we have redeemable and we have irredeemable. Start with the first one. Irredeemable bond. From a valuation point of view, I remember we talked about redeemable and irredeemable, and of course we also had the convertible. So for the irredeemable, something that is irredeemable is something that is not refundable. So irredeemable bonds, they don't mature. So these bonds don't mature, do not mature. They do not mature. So they'll be there forever. Sorry guys, my network is a little bit shaky. So let us recall pale kwa kucalculate the value of the bonds. Our market value was equals to, remember how to value the bonds? It was interest. We divide by what? KD. The redeemable bonds was equals to interest over KD. Now, in our case, we need to make KD the subject. So if we make KD the subject, we make KD the subject of the equation, itakuja hapa, ikuje hapa. So KD equals to interest divided by what? Divided by the market value. So interest over the market value, that will give us the KD. Nice. Then we say, in case of a discount, in case of a discount, in case of a discount, that is D, or flotation cost, in case of a discount or flotation cost, comma, it reduces the price. It reduces the price. Hence, so discount, comma, if the shares are issued at a discount, sorry, if the bonds are issued at a discount, instead of selling them at 30, kwa market unaziuza na 30 lakini unapewa discount ya 2 shillings, utaziuza na 30 minus 2. So kama kuna discount ama flotation cost, ita reduce the market value. Simple as that. Then can give me an NB. Can give me an NB. Then you say, the ideal KD is the after-tax, KD. Since interest is a tax allowable expense. Wakati una prepare the income statement, the P&L, the finance cost, the interest inakwanga expense before taxation. When you look at the expenses in the income statement, the P&L, while preparing the P&L, unakuwa na sales, you less the cost of sales, you get the gross profit, you less the operating expenses, you get the operating profit, which is like our EBIT. Then you less interest to get profit before tax, do less tax. So the amount of interest that you less will affect the amount of tax that you are going to pay. So it has interest has an effect on the tax amount that the company will pay. Because after that is when now you'll pay, after lessing tax, you get profit after tax, then you can less the preference dividends if you have them. Ndio kuja upate the profit after tax and preference dividends, you less this other ordinary share dividends. So out of them, it's only interest that comes in before taxation. So it will affect the amount of tax that you pay. That's why we are saying the KD should be the after-tax KD, since interest is a tax allowable expense. Hence, KD equals pre-tax KD, then we adjust for tax, 1 minus tax. The ideal KD becomes the pre-tax KD. Hii iko hapa ndio pre-tax KD. Then you simply adjust for tax. So hii ni pre-tax KD. So that means I can bring this here to be my pre-tax KD. Sorry. So this is my pre-tax KD. Lakini hapa I'll do into 1 minus T. So into 1 minus T. So this is the before tax KD. Then you adjust for tax to get the after tax KD. Hope that is clear. And if you are fine with that, we go to number 2, the redeemable bonds. Redeemable bonds. And of course, for the redeemable bonds, just for our own understanding, these ones, they mature. They mature. They have a maturity period. Kama ni za 5 years, after 5 years, they'll mature. So they'll mature. Great. So you say, we apply the concept of bonds yield to maturity. Bonds yield to maturity into brackets YTM. When calculating the pre-tax KD of redeemable bonds, when calculating the pre-tax KD of redeemable bonds, so let's just tell ourselves what, I'll just give the formula of YTM. So YTM equals we have interest plus 1 over n into brackets MV minus BV ama FV ama PV. I'll explain it. We divide everything. This is plus, not equals. Interest plus. Then we divide by a half into MV plus BV. So that is the formula of YTM. interest plus 1 over n into mv minus bv over a half into mv plus bv. Just note where the signs are. Juu ni minus, chini ni plus. Where mv equals market value and bv equals book value stroke par value stroke face value. Hata inaitwa nominal value. That is the formula of getting the YTM, yield to maturity. Now, remember what we've said, that yield to maturity gives us the pre-tax KD. We apply to calculate when calculating the pre-tax KD. Now, for us to get the ideal KD, we shall take the yield to maturity, then we into 1 minus tax. Just as we said, YTM into 1 minus T, because YTM is before tax KD. So if you want to get the ideal KD, should be the after tax KD. So can we have our KD? So if you want to get our KD, we shall have that. Alafu hapa into 1 minus T. Na hii sasa itakuwa YTM. Sasa this one will now be KD. Kama haina tax ni YTM. Ukiadjust for tax inakuwa KD. And that is the summary of the component costs. KE, KP, and KD. Any question? If you are all okay up to that point, give me a subtopic on weighted average cost of capital. Weighted average cost of capital into brackets WSEC. Weighted average cost of capital, that is WSEC. Then you can say it is a combined cost. It is a combined cost of existing funds. It's a combined cost of existing funds invested in firms' existing projects. Invested in firms' existing projects. So the WSEC is the cost of available funds, the cost of what we have, the cost of funds that have currently been invested or injected in existing projects of the company, the projects that are currently running. Steps of calculating WSEC, small subtopic. Steps of calculating WSEC. Step number 1, calculate component costs. Calculate component costs, i.e. KE, KP, and KD. Calculate the component cost, that is KE, KP, and KD. Hizo tumeona vile tunazicalculate hapo juu. Number 2, calculate the weights stroke proportions of each capital component calculate the weight stroke proportions of each capital component in the firm's capital structure. Calculate the weight stroke proportions of each capital component in the firm's capital structure. Then under that you say, we use the market values. We use the market values to calculate weights. For the following reasons, for the following benefits. There's a question that was tested some time ago. I can't remember the setting. They asked about the advantages and disadvantages, 2 advantages, 2 disadvantages of using the market values. You can just highlight some 2 advantages or 3 and other disadvantages. So number A, market values give a more realistic position of the firm's operation, of the firm's current operations, unlike historical book values. So kutumia market values inakaa more real compared to the historical book values. Number B, investments are always valued at their market rates. Investments are always valued at their market rates. Hence, their cost should also be determined based on the market. Hence, their cost should also be determined based on the market. Let's have 3. Number 3. Assets used as collateral are always valued as per the market. Assets used as collateral are always valued as per the market. Hence, the funds raised should also be evaluated on their cost based on the market. should also be evaluated on their cost based on the market. Can skip one line, then you talk about the disadvantages. So disadvantage or demerits of using the market value weights. Demerits or disadvantages of using market value weights. Number A, they are difficult to calculate and apply. Hiyo ni point ya kupita mtihani, si ati ni ngumu kuzicalculate. They are difficult to calculate and apply compared to book values. They're difficult to calculate and apply compared to the book values. Number B. Use of market values. Use of market values is not realistic. Is not realistic. Since practically security prices will always fluctuate. Security prices will always fluctuate. And will not remain constant and will not be static. And will not be static. So the price in the price ya asubuhi ni tofauti na price ya mchana, lakini hapa tumesema price ni 30, so inabaki 30 forever. That is not very realistic. Tulisema tupeane points tatu. Number C. By using market values, there is an assumption that the financial markets, there's an assumption that the financial markets are efficient. The financial markets are efficient such that the prices are known in advance. The prices are known in advance and with certainty. The prices are known in advance and with certainty. Step number 3. So by the way, hapa kwa step number 2, we calculate the weights or the proportions. Now step number 3, multiply each component cost. Each component cost by the respective weight to get the weighted component costs. i.e., so you shall take the weight of equity, you multiply by cost of equity. We take weight of preference shares, we multiply by cost of preference shares. And we also take the weight of debt, multiply by cost of debt. W is for the weight. Finally, step number 4, add the weighted component costs. together to get WSC. So therefore inamaanisha kuwa WSC will be equals to weight of equity times cost of equity plus weight of preference shares times cost of preference shares plus weight of debt times cost of debt. So that is our cost of capital. Let's see if we can So as we conclude on that, we can take some time and look at question 4B of December 2023. Question 4B of December 2023.